Across energy markets today, the quiet story of uranium is becoming the loudest spark in a crowded room. Governments back new reactors, utilities, lower emissions, and investors chase a supply crunch that could reshape power grids for decades. The global rush toward carbon-free energy makes uranium essential, while geopolitical tensions expose the fragility of fuel supply chains. Cheap solar and wind still lead headlines, yet nuclear fuel offers consistent baseload power, weathering the intermittency of renewables. This topic matters now because supply limitations meet policy ambition, creating a rare alignment of risk and opportunity in energy markets today. At its core, uranium is fuel for the world's reactors, not a speculative metal for fast marketing cycles. Operators convert ore into concentrate and then enrich it to create fuel rods that heat water into steam, turning turbines that produce electricity. Demand centers cluster around utilities and countries pursuing low-carbon grids. Right now, new reactor restarts and build programs collide with limited mine output, aging inventories, and long lead times for mining and conversion. The market moves as buyers secure dependable supply while miners and refiners adjust capex, project timelines, and production quotas to reflect the evolving policy landscape. To understand where we stand, you must rewind decades of uranium history. The fuel has powered nuclear nations since the Manhattan era, peaking in the boom years when traders treated uranium like a tech commodity. Prices surged during the 2007-2008 spike to over $100 per pound, then collapsed after Fukushima when reactors paused and utilities paused new builds. The market settled into a prolonged lull, while major producers like Cameco and Kazatomprom expanded or reduced output according to long lead times. In recent years, financial buyers entered, notably the Sprott trusts, reshaping marginal supply and signaling renewed interest in the asset class. Markets are finally pricing in a nuclear-led revival, but the signals are mixed and volatile. Spot uranium has traded in a wide range, oscillating around $60 to $80 per pound, as buyers seek visibility on both demand and supply. Utilities sign longer-term contracts to lock in predictable costs, while miners adjust mine plans, capex, and staffing to meet a less forgiving price band. ETFs and listed vehicles have attracted new money that previously shunned the sector, and specialized funds now compete for access to physical uranium or forward sales. The macro backdrop of inflation, rates, and energy security adds multiple moving parts to pricing. Major utilities and diversified energy players stand at a crossroads between price risk and carbon targets. Reactor operators need predictable fuel costs to plan outages and load factors, so long-term contracts rise in importance. Mining majors and state producers face higher capex and project delays, yet systemic demand supports development of new mines and conversion facilities. Financial buyers, hedge funds, and retail investors increasingly treat uranium as a strategic asset, evaluating storage, leverage, and timing of entry. Equipment suppliers, enrichment plants, and transportation groups also feel the ripple, since every link from ore to fuel affects costs and project economics globally. Geopolitics and macro trends shape every heartbeat of this story. Nuclear energy is increasingly framed as energy security, pushing governments to diversify away from single suppliers. Russia and Kazakhstan remain large exporters, while Western buyers seek alternate sources and more robust stockpiles complicating trade flows and sanctions navigation. Inflation, interest rates, and currency moves influence capex budgeting for new reactors and enrichment capacity. The energy transition also interacts with power prices, grid reliability, and storage solutions, making uranium a strategic asset rather than a fringe commodity. In short, policy shifts and currency cycles amplify both upside potential and downside sensitivity. Smart money is testing the edge of scarcity with disciplined positions and diversified exposures. Institutions have built modest long positions, hedging against inflation and forcing comparison with traditional energy equities. ETFs and trusts focused on physical uranium have attracted new inflows as spot volatility increases and long-term contracts look steadier. Retail traders, drawn by dramatic price moves and social media chatter, have created anecdotal bubbles, then cooled as inventories adjust. Banks and brokers price risk into forward curves, while miners emphasize debt discipline and mine planning to absorb higher input costs without over-leveraging. This dynamic shapes confidence and caution across markets. Every thesis has a counterweight, and the uranium story is no exception. A renewed price crash could crush project economics and push some mines out of feasibility, creating tighter supply with even slower growth. Regulatory risk remains as safety standards, waste management, and permitting delays complicate development timelines. Technological shifts towards small modular reactors or high burn-up fuels could alter demand patterns. Meanwhile, geopolitical escalation could trigger supply disruptions, sanctions, or new export controls, swamp markets with anxiety, and invite overreaction in hedges and speculative bets. In short, the risk is real, persistent, and conditionally amplified by timing and policy. For retail investors, the uranium theme is a way to diversify energy exposure without relying on single stock bets. Start with education on what drives prices: utility demand, mine supply, and enrichment capacity. Consider risk-controlled access through diversified vehicles rather than chasing volatile headlines. If you believe in a longer-term revival, use a measured position size, set stop losses, and rebalance as contracts and spot moves unfold. Avoid overexposure to any one miner, monitor debt loads, and watch for project delays or political flare-ups. Finally, combine uranium exposure with other energy assets to smooth potential volatility cycles. Looking ahead, the uranium renaissance may unfold in stages rather than a single boom, with supply discipline and policy clarity serving as catalysts. Demand could surprise to the upside as reactors come online and capacity finally catches up with planned builds, while the bear case remains intact if curtailments extend or if price expectations temper new investment. Long-dated power contracts and strategic stockpiles can provide ballast to portfolios, but access remains uneven across regions. For investors, patience and diversification inside and beyond energy are the watchwords. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.